Welcome back to What Changes. I am your host, May, and today we are diving deep into a financial reality that most of the world is completely blind to. As a financial analyst, my job is to look past the surface level noise and uncover the mathematical truths hidden in the charts. Before we expose the massive wealth transfer currently underway, please take a moment to hit that subscribe button. I highly encourage you to join our exclusive Telegram channel and follow us on X. You will find the links to both in the YouTube description below, along with my top book recommendation for navigating the turbulent economic waters ahead. Right now, the global economy is experiencing a chronic debasement of currency, but it is happening right under everyone's noses, entirely unseen by the general public. We are living through an era that can only be described as a grand financial illusion. People look at their stock portfolios, their real estate valuations, and their retirement accounts, and they see the numbers going up, which gives them a false sense of security and prosperity. However, this is nothing more than what has been brilliantly termed the Jedi mind trick, or the nominal normie effect. This effect occurs when individuals see nominal prices rising, but they completely fail to recognize that the actual unit of account, the currency they are using to measure their wealth, is fundamentally broken and rapidly losing its purchasing power. To truly understand what changes are happening in the macro environment, I have to make the compelling case that we do not have a single valid unit of account in any fiat currency representing any nation in the world right now. The reality is that since the formation of the Federal Reserve in 1913, we have witnessed a massive, unprecedented financialization of absolutely everything. This long-term trend has culminated in the creation of the everything bubble, a financial anomaly where all asset classes appear artificially inflated. Unbeknownst to the vast majority of mainstream investors, this immense bubble is already in the process of deflating. The only reason this deflationary collapse is not being widely observed or reported on the nightly news is that people are stubbornly watching the markets through the distorted lens of fiat currencies. They are looking at dollar-based NASDAQ valuations, European euro-based indices, or the FTSE 100 measured in the British pound. Because the masses are using a collapsing measuring stick, we are essentially being played for fools. We are like monkeys sliding down a heavily greased pole, completely oblivious to the fact that the unit of account is the very thing carrying the debasement. This entire system of debasement is inextricably tied to the concept of debt, which must be understood if you want to protect your capital. When you reduce the global financial system down to its simplest, most foundational elements, debt is really nothing more than fiat currency attached to a timeline, a deferment, and a rental agreement, which we commonly refer to as the interest rate. Currently, we are seeing both the fiat currency and the underlying debt mechanisms devalue at a chronic and accelerating pace. This brings us to a pivotal moment in recent economic history. The year 2020 marked an incredibly significant turning point for the global economy, representing the ultimate turn of the bond market after decades of structural changes. To understand the gravity of this shift, we have to look at who is actually buying the debt that keeps the American economy functioning. Historically, the United States has run record deficits by relying on two key economic trade zones, the Eurozone and China. But a massive paradigm shift has occurred, and these traditional buyers are no longer aggressively purchasing the long end of the yield curve, specifically the 10-year, 20-year, and 30-year treasuries. So, who is stepping in to absorb this massive issuance of debt? Astonishingly, roughly 37% of this debt has been purchased and held by entities in the Cayman Islands, utilizing highly leveraged basis trade funding. This precarious debt situation echoes the dangerous mechanics we saw during the subprime crisis and Operation Twist, where Ben Bernanke was buying up the long end of the curve and making shorter duration debt available, much of which was absorbed by China at the time. But today, China has let a significant portion of that debt run off its balance sheets, leaving the United States in a vulnerable position as global players step away from funding American deficits. Meanwhile, the average holding of gold in general hedge funds sits somewhere between an abysmal 0.5% to 2%. Think about how reckless that is from a risk management perspective. It is conceptually identical to insuring your house or your car for merely 2% of its actual replacement value. That does not mean you should put 100% of your net worth into precious metals, but it overwhelmingly indicates that you should be significantly overweight in gold right now. Let us shift our focus to the stock market, where the illusion of wealth is perhaps the most intoxicating. Many investors look at international equities, such as the Japanese Nikkei index, and view it as an absolute gift of a market. Since 2009, its nominal performance has been nothing short of tremendous, breaking out of a massive inverted head and shoulders pattern. It has finally pushed through the legendary legacy highs of 1989, a peak established during the infamous Japanese economic bubble era, and it currently has technical targets pointing towards 74,000. If you look at this chart in pure fiat terms, you might be asking yourself why you are not heavily long the Nikkei right now. But the truth is, if you participate in this market, you will actually be deeply underperforming in terms of real wealth generation. You will be trapped in a state of rebasement because the Nikkei famously went sideways and down for the better part of 3 decades. The minute you take the Nikkei index and divide its value by an ounce of gold, a terrifyingly different chart emerges. Priced in real money, the Nikkei is generally graduating to the lower end of the chart, proving that its massive nominal gains are a byproduct of currency debasement, not true economic value creation. This exact same phenomenon is playing out with absolute brutality in the American markets, specifically within the tech-heavy NASDAQ. The United States has a deeply ingrained culture of equity, where holding stocks is considered the undisputed path to wealth. On the surface, the NASDAQ looks like a beautiful, unstoppable index that consistently delivers returns. But remember, fiat currency is just a monkey on a grease pole slipping into a tar pit, and you must compare your assets against gold to reveal the true proliferation of fiat money. When we divide the NASDAQ by the price of gold, we see that a massive historical threshold has recently been crossed. Historically, there was a prolonged period from 1980 onward where holding gold was actually a disadvantage due to the rampant financialization of everything into the technology sector. This created a hugely beneficial era for tech stocks leading up to the dot-com bubble in 1999 and 2000, which was subsequently followed by a very violent market correction. Following the subprime mortgage crisis, we entered the era of quantitative easing, where a massive flood of newly printed initial money flowed directly into technology and growth stocks, fueling a second, albeit lesser, bull market from 2012 straight through to 2021. But where exactly are we now, and what does this mean for your portfolio going forward? The technical message is incredibly stark. When analyzing the NASDAQ priced in gold, we can clearly identify a massive, multi-year head and shoulders pattern that analysts have been anticipating for quite some time. We have a distinct left shoulder, a complex head structure formed at the peak, and the right shoulder has now fully materialized. In the month of February, the critical neckline of this massive pattern was aggressively tested. There was an initial rejection at the neckline that led to a brief rally, but that rally has now been fiercely rejected, pushing the price action right back down through the opening levels. What we are witnessing right now is the triggering event of a major historic reversal in the relative valuation of technology stocks compared to a single ounce of gold. To fully grasp the sheer magnitude of this impending collapse, consider the specific numerical values on this ratio chart. At the absolute peak of the tech mania in 2021, the NASDAQ to gold ratio was sitting at roughly 9. Back during the peak of the dot-com bubble in 1999, the ratio was around 4.65. With the recent triggering of the neckline, this ratio has definitively broken below the 4.65 level, currently sitting around 4.41. The meticulously calculated downside targets for this massive structural breakdown take the ratio all the way down to 1.4, and potentially even lower. Let me be perfectly clear. The NASDAQ has just broken against gold, and this is an absolute disaster for anyone heavily allocated to tech. Some of you might be wondering about cryptocurrencies as an alternative safe haven. You might ask, what about Bitcoin? Doesn't it deliver alpha against gold? The reality, according to strict technical analysis, is that Bitcoin is failing entirely. When subjected to the exact same rigorous criteria and divided by the price of gold, it becomes glaringly obvious that investors are divesting from Bitcoin in a radical and rapidly accelerating manner. You have to remember that the massive exponential gains seen in the early days of crypto, the era of surging fundamentals and aggressive pumping, occurred when the total market capitalization was incredibly small, back around 2012. Back then, it took vastly less new capital to drive the price up dramatically. Today, with a market cap exceeding $1 trillion, the dynamics have fundamentally changed. If you step back and view the long-term charts on a regular non-logarithmic scale, which is the mathematically correct way to view relative performance over time, Bitcoin's chart against gold shows absolute catastrophic rejection. It represents a technical failure across multiple levels. This failure was pre-seen by astute analysts because the incredible cycle high of 2021 and 2022, where Bitcoin reached roughly $69,000, was actually only a marginal, fractional high when priced in ounces of gold. Specifically, it topped out just around 40 gold ounces. For multiple cycles, Bitcoin has been violently battling to make higher real highs, and it is completely failing to do so. The technical charts are screaming that there is simply not enough new, incoming fiat money to continuously scale Bitcoin to exponential valuations relative to gold. The proof is undeniable. Bitcoin is puking, suffering through 7 straight months of devastating losses in gold terms. All of this carnage across equities and digital assets stems from the fundamental rotting of the fiat currency system, primarily led by the fall of the United States dollar. In the global financial landscape, fiat currencies are essentially an absolute leper colony, where every single participant is deeply ill with the exact same terminal disease of debasement. The dollar may occasionally exhibit moments of dominance against its peers, benefiting historically from Triffin's dilemma, where the US exports inflation to the rest of the world. However, the dollar is ultimately just the scabbiest leper in a contaminated colony. From a technical perspective, the dollar has suffered a monumental breakdown. It was previously trading within a defined channel, bouncing against an 18-year trend line that originated during the depths of the 2008 financial crisis. The dollar has now definitively broken to the downside of this massive historical trend line, and there are multiple structural setups indicating severe downside targets ahead. The US has operated for decades as a rabid consumer nation, surviving and thriving entirely at the cost of everybody else on the global stage. Now, the consequences of that prolonged, unchecked consumption are manifesting as a rapid, violent unwinding. People who have only experienced the favorable economic conditions of the recent past think that market cycles are simply one good year followed by one bad year. They have absolutely no frame of reference for the unwinding of a multi-generational debt supercycle. There are massive cycles where the economic conditions just stay bad because market participants simply do not realize how artificially good they have had it for so long. So, where does a rational investor turn when the stock market is a mirage? Bitcoin is facing absolute technical rejection, and the primary reserve currency of the world is collapsing through an 18-year support level. The answer lies in the ultimate, time-tested basis of account: precious metals. Let us deeply examine the silver market, because what is happening here is truly historic. We are looking at a massive, multi-generational technical setup that actually traces its origins all the way back to 1964 and the geopolitical tensions of the Gulf of Tonkin. You could even argue the structural foundations of this trade began with the very formation of the Federal Reserve. This pattern is known as an HVF setup, which essentially represents a massive, prolonged squeeze in market volatility where price action funnels into a tighter and tighter consolidation over decades. Within this massive macro structure, we recently experienced a squeeze within a squeeze, acting as a powerful primer for the explosive move to come. Prominent analysts, such as Brent Johnson, accurately called for a significant breakout when silver crossed the $25 threshold, predicting that the silver guys were going to lose their minds with excitement. However, as Francis Hunt pointed out, crossing $25 was not the end of the story. It was merely the absolute beginning of something far bigger. Trading precious metals requires the unparalleled patience of a monk. It is a grueling, exhausting generation cycle that has taken an immense amount of pressure to finally break the back of the great American economy and the unchecked proliferation of its currency. The breakout started quite slowly, but everything changed the moment silver ran past the critical interim target of 90.58. Once that level was breached, astute traders were put on high alert, rapidly reducing their leverage size and shifting into pure, unleveraged investment preservation mode. When silver crossed that crucial line, it possessed so much momentum that, much like a Bugatti Veyron slamming on the brakes at top speed, it still took several meters to finally stop, ultimately running all the way up to $120. Following that explosive run, silver experienced a sharp pullback, violently returning to form a classic shooting star candlestick pattern on the longer-term charts. To the uneducated observer, this looked like a massive, terrifying rejection of higher prices. But to a seasoned technical analyst, this aggressive pullback was a perfectly natural, expected refilling of the active quarterly candle. By the end of the 3-month period, closing around March 30th or 31st, that massive rejection wick will be almost entirely erased. The green body of the candle will push all the way back up, making the perceived rejection look like nothing more than a minor, insignificant detail on the long-term path higher. The primary, unadjusted target for this explosive move in silver is an astonishing $333 per ounce. For those who think a target of $333 is overly aggressive or ballsy, it is crucial to understand that this projection is derived from analyzing the charts on a standard, regular scale, not just relying on logarithmic compressions. The trajectory is clear. Silver triggered out of its primer phase, ran through the 90s in quick succession, rested to refill the wick, respected its second interim support levels perfectly, and has already begun the impulsive reversal phase, targeting massive new highs. We are officially in a capital preservational era, completely detached from the hypergrowth speculation of the previous decade. This is absolutely not the time to be overweight in general stocks. It does not matter if you are holding supposedly bulletproof tech stocks, the latest cutting-edge AI companies, or the broader composite index constituents. The broader equity market is fundamentally the wrong place to store your wealth right now. Gold is your necessary overweight allocation. Gold is the primary, unfiltered basis of account in a world drowning in fiat illusions. Despite the overwhelming technical and fundamental evidence, the vast majority of the public is entirely asleep. People constantly ask financial analysts, when is the Great Reset going to happen? They wait for the reset as if it will be a singular, cinematic moment, a neon sign illuminating the sky at exactly 5:01 p.m. on April 23rd, accompanied by a ringing bell to signal that the old system has died. They are looking for an obvious, undeniable sign to pour a drink and finally acknowledge the crisis. But the terrifying reality is that this is not a single, isolated event. It is a slow, grinding process, and that process has already begun. The Great Reset is not coming in the future. It is actively happening right now, every single day, as the purchasing power of fiat evaporates. People are sleeping on the undeniable fact that the greatest financial debasement in human history is currently ongoing and running at full speed. The nominal normie effect is keeping the masses sedated while their actual wealth is systematically extracted. The smart money, the institutional players who understand the mechanics of chronic debasement, recognize that the only valid unit of account left standing in this collapsing leper colony of debt is gold. Do not be the person who realizes the house is on fire only after it has burned to the ground. You need to adjust your macro-technical analysis, drastically reduce your exposure to inflated tech equities, ignore the false promises of digital tokens failing against real money, and aggressively position yourself in the one asset class that physically cannot be printed into oblivion. Thank you for tuning in to this crucial update on what changes. If you want to survive the ongoing wealth transfer and stay ahead of the massive macroeconomic shifts we discussed today, you must stay informed. Please make sure you join our Telegram channel and follow us on X for real-time alerts and deeper technical breakdowns. You will find all the relevant links, along with my mandatory reading book recommendation for navigating this crisis, in the description below. Until next time, stay vigilant, protect your capital, and do not fall for the grand illusion of fiat wealth.